All right, hello everyone. I want to take a look at three different things today and see what we can learn. Now, I spent 2 decades in the institutional trading world, and I could tell you this: the best traders don't make things too complicated. They focus on what are the important price levels, what are the important trends, what's the momentum, and they think about psychology. Now, here we have Marathon Digital Holdings. You'll notice that for whatever reason, sometimes we know and sometimes we don't know, but for whatever reason, this 19 or 915 level is really important. It became support here, and it became support here, and then it was support here before we fell off. And then notice this, it became resistance. So support is a large group of investors who are gathered around the same price, looking to buy shares for close to or at the same price, in this case around 915. When a market's moving lower, it's because there's not enough buyers or demand to absorb all of the supply or sellers. But when we get to a support level, that changes. All of a sudden, there's more demand than there is supply. Now, some of these investors who want to buy start to get the sense that there are other buyers around. That's why the price hasn't gone any lower. And they start to get worried that they're going to miss it. So, unless you're willing to pay a higher price than anyone else, the seller is going to go to someone who will. So, someone might say, all right, well, I was going to try to buy it at 915, but I'm going to go to 920 because I don't want to miss it. Someone else say, I'm going to go to 925. Someone else might say, oh, I'm going to go to 930. And you get a snowball effect. And the same thing happened here. Now, when a market is moving higher, it's because there's not enough supply or resistance. Not enough supply or sell orders to fill all of the demand. So the buyers are forced to pay a premium, and this forces an uptrend. When there's not enough demand to absorb the supply, well, the sellers are forced to offer their shares at a discount, and this forces a downtrend. The opposite is true when the market's going up. There's not enough supply to fill all the demand, so the buyers need to be willing to pay a premium, and this forces an uptrend. When we get to resistance, the tide turns. At a resistance level, there's more supply than there is demand, right? More sell orders than there are buy orders. Now the same thing happens but it's the opposite, right? The opposite, but the same principle, but it's the opposite. The sellers start to get the sense that there are other sellers around. That's why. So resistance is a large group of investors trying to sell at or close to the same price. When the price stops going higher, some of these sellers start to get the sense that, oh, there's other sellers lurking around. That's why the price isn't going any higher. And they start to think, oh boy, I'm going to miss it. So instead of selling at 915, I want to have the lowest price around so any buyer comes to me. So one person might go to 910, the next person might see that, they go to 905, next person sees that, they go to 9, and we start a snowball effect on the downside. Now, notice how the level that was support back here became resistance over here. How could this happen? Well, this happens because of buyer's remorse. There are people who bought it back here around 915, and when the price went lower, assuming they still held it, a lot of them experienced buyer's remorse. They say to themselves, I made a mistake. I shouldn't have done that. I'm going to get out, but here's the deal. I don't want to lose any money, so I'm going to place my sell order at the same level that I had my buy order. So if you have enough of these remorseful buyers placing sell orders, the level that was support can convert into resistance. Next up here, we have Amazon, and we could see support converted into resistance here. We could also see this, resistance converted into support. This happens because of seller's remorse. Investors sell, and a lot of them regret doing so when the price goes higher, and they tell themselves, I made a mistake, I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price I sold them at. So if you have enough remorseful sellers placing buy orders at the level that was resistance, it can turn into support, right? So buyer's remorse can turn support into resistance. Seller's remorse turns resistance into support. For some reason on Amazon, these three levels are very important. We don't know why, but they just are. We don't need to know why. We just need to know where they are. 103, 110, and 125. Now that you understand how resistance can become support and support can become resistance, let's talk about a gap. A gap is a place on a chart where there's no trading. This Amazon closed here on this day. The next day it opened up down here. So there was no trading there. So if there's no trading, guess what? There's going to be no one who bought it who is a remorseful buyer. So when the price eventually comes back and we get back into that range, well, the buyers are forced to pay higher prices. They're going to have to aggressively bid because there's just not going to be a lot of supply around. You're not going to have remorseful buyers trying to sell, and that creates resistance. So we get up to here, support becomes resistance, then we go right back down. Now, how come we could go ripping right up, gapping up and gapping down? Well, it's the same principle. Because it didn't trade at these levels, there's no one who sold it who's going to try to buy it back at the same price they sold it at. It just didn't trade there, so it just isn't going to happen. So if you understand how buyer's remorse can turn support into resistance and seller's remorse can turn resistance into support, you can understand why gaps form. There's an old saying, gaps refill. And that means when the market gaps one way, if the price moves away from it and then comes back into the gap, there's a good chance it moves really fast back through that gap. Now here we see gold, right? Support becomes resistance. Resistance becomes support. All right, remember buyer's remorse turns support into resistance. Seller's remorse turns resistance into support. So trading and technical analysis really don't need to be as complicated as a lot of people seem to think they do, or think they are. We just focus on these basic principles. What are the important price levels? What's the trend? And what's the investment psychology? Remember, when we look at a chart, we are looking at a picture of investment psychology or human psychology. If you look at a chart right, at least, that's what you should be thinking. See, once again, here we got resistance becomes support. Resistance becomes support. Down here, we can see this is a support level that stayed intact for a while. All right. So again, everybody, please sign up for our YouTube community here. Please sign up for our page. Visit our website, stockmarketjobber.com. And just remember, keep it simple. Just pay attention to what price levels are important, what's the momentum, what's the trend, and what's the psychology. And if you do that, you're going to be well on your way to being successful. All right. Thank you, everybody. I will see you soon.